What are interest rates anyway? You might think of them as just the cost of borrowing money, but their influence reaches far beyond that simple definition. Imagine you're in a local bakery. If the cost of borrowing money, let's say to buy new ovens or expand the shop, increases, the baker might raise prices to cover those costs. This, in turn, affects how much you're willing to spend on pastries. It's a cycle, and that's just the beginning. Interest rates are set by central banks, like the Federal Reserve in the US. When they raise rates, it becomes more expensive to borrow money. Businesses will hesitate to take out loans for expansion, and consumers might put off buying that new car or home. Fewer loans mean less money flowing through the economy, which can lead to a slowdown in growth. Think of it as tightening the belt on a garden hose. Less water can flow through, and the garden, our economy, starts to wilt. Now here's the surprising part. Interest rates don't just affect borrowing, they also influence savings and investments. Higher interest rates can encourage saving, as banks offer better returns on deposits. However, this can be a double-edged sword. While some might save more, others may cut back on spending, fearing a decline in economic activity. This is why central banks carefully consider their moves. Balancing growth and inflation is like walking a tightrope. So, interest rates are not just numbers, they're the pulse of the economy, affecting everything from your local bakery to global markets. Understanding this mechanism helps you see how interconnected our financial lives really are. And if you want to dive deeper into more economic concepts, consider subscribing for more insights. When interest rates drop, borrowing becomes cheaper. Imagine it like a big sale at your favorite store. Suddenly, the price tag on loans isn't as daunting, and more people are eager to take a shopping cart and fill it up. This isn't just about shopping though, it's about the entire economy. Let's break it down. Think of interest rates as the price of borrowing money. When rates are high, it's like paying full price for everything. You might think twice before buying that new car or renovating your home, because the cost of borrowing is steep. But when interest rates fall, it's like a clearance sale on loans. You see that shiny new car, and suddenly it's within reach. Here's how it works under the hood. Lower interest rates reduce monthly payments on loans. For example, if you're looking to buy a house and the mortgage rate drops from 4% to 3%, your monthly payment decreases significantly. This extra cash can then be spent elsewhere, maybe on dining out or taking a vacation. And here's the surprising part. As people spend more, businesses notice an uptick in sales. When businesses see increased spending, they respond by hiring more staff or expanding operations. This creates more jobs, which means even more people have money to spend, fueling a cycle of economic growth. But remember, this cycle hinges on the cost of borrowing. The lower the interest rates, the more people are willing to borrow, and that spending ripple effect can boost the entire economy. In short, when interest rates drop, borrowing becomes cheaper, leading to increased spending and a cycle of growth that benefits everyone. Understanding this connection is key to grasping how central banks influence our daily lives. If this clicked for you, consider subscribing for more insights into how these economic gears turn. When consumers start spending more, it's like dropping a pebble into a pond. The ripples move outward, affecting everything in their path. Here's how that works for businesses. Picture a small coffee shop. When interest rates are low and consumers feel financially buoyant, they're more likely to grab that extra latte or pastry on their way to work. This increase in demand means the coffee shop sells more, and that's where the magic begins. Now here's the surprising part. As sales rise, the shop owner may decide to hire another barista to keep up with the rush. That new employee now has a job and a paycheck, which means they can spend more too, maybe on a new pair of shoes or dining out. This is where we see the domino effect kick in. Next, the shoe store and restaurants benefit from that new spending. Suddenly, businesses across the neighborhood start thriving. They might invest in new equipment or expand their services, which generates even more jobs. It's a cycle that builds upon itself, with each new job leading to more income and more spending. But it doesn't stop there. When businesses thrive, they often invest back into the community. They might sponsor local events or support charity initiatives, which can further boost the local economy. It's like a chain reaction. One small change in consumer spending creates a ripple that touches many aspects of the economy. So when interest rates are low and consumers are feeling good about their finances, it's not just about one person spending a little more. It's the beginning of a chain reaction that can spark growth across entire sectors. This interconnectedness is what makes the economy so dynamic, and understanding it can help you see how one piece can influence everything else. If you found this eye-opening, consider subscribing for more insights into the economy's inner workings. How do central banks shape the economy just by adjusting interest rates? Imagine a conductor guiding an orchestra. Each musician has a role, but it's the conductor who brings everything into harmony. This is precisely what central banks, like the Federal Reserve in the United States, do with the economy. When a central bank lowers interest rates, it's like giving the orchestra a cue to play a softer melody. Cheaper borrowing costs encourage businesses and consumers to take out loans. This leads to more spending on everything from home purchases to business expansions. In turn, this increased demand can help push the economy forward, creating jobs and fostering growth. Here's the surprising part. If the economy starts to overheat, think of it like an orchestra playing too loudly with too many musicians. Central banks can raise interest rates. Higher rates are like telling the musicians to dial it down a notch. When borrowing becomes more expensive, businesses may scale back their expansions, and consumers may think twice before taking out that new loan for a car. But the role of central banks goes beyond just managing growth. They're also tasked with controlling inflation. If prices rise too rapidly, that can erode purchasing power. By adjusting interest rates, central banks can influence the amount of money circulating in the economy, helping to keep inflation in check. So in this grand economic performance, central banks act as the conductors, ensuring that all the parts of the economy work together harmoniously. Understanding this role helps illuminate why interest rate changes can have far-reaching effects, not just for businesses, but for all of us. But what happens when interest rates rise? Imagine you're planning to cook a big meal, and suddenly someone cranks up the heat on your stove. What happens? Everything cooks faster, and you have to adjust your timing. The same principle applies to the economy when interest rates increase. When central banks, like the Federal Reserve, raise interest rates, borrowing money becomes more expensive. Picture a family wanting to buy a new home. If mortgage rates rise, their monthly payments jump too. Suddenly, that dream home feels less affordable. So they might decide to wait, maybe even a few years before making that big purchase. This ripple effect starts to slow down the whole housing market. Now, let's look at businesses. A company that planned to expand by building a new factory might hit the brakes when borrowing costs climb. If they need a loan to finance that construction, higher interest means higher repayments. So they could choose to postpone that expansion, reducing their spending and investment. When many businesses adopt this cautious approach, the economy begins to cool down. And here's the surprising part. While rising interest rates can help control inflation by slowing spending, they also risk pushing the economy toward a slowdown or even a recession. Consumers cut back, and businesses become hesitant. It's a balancing act that central banks must navigate carefully. So rising rates mean tighter budgets for everyone, from families to corporations. Understanding this mechanism helps you see why our economic landscape shifts when rates move. And that's how interest rates can turn up the heat in the economy, often with unintended consequences. If this explanation clicked for you, consider subscribing to learn more about how these economic gears turn. How do interest rates really tie everything together in the economy? Imagine a high-wire act, where the performer maintains balance by shifting their weight. Too much on one side, and they risk falling. That's exactly how interest rates influence not just borrowing, but spending and investing across the economy. When interest rates rise, it's like the performer leaning to one side, making borrowing more expensive. Consumers feel the pinch. Think about a family deciding to buy a new home. Higher mortgage rates could mean a larger monthly payment, which might lead them to delay that purchase or even settle for a smaller home. This ripple effect slows down the housing market, impacting everyone from builders to real estate agents. On the flip side, lower interest rates create a different scenario. Imagine the performer finding their center, stabilizing their position. With cheaper loans, businesses are encouraged to invest in new projects and hire more workers. This can lead to economic growth, but it's a delicate balance. Too low for too long, and you risk overheating the economy, leading to inflation, where prices start rising too fast. Here's the surprising part. The Federal Reserve, the central bank, plays the role of the ringmaster, adjusting rates to nudge the economy in the right direction. Their decisions impact not just banks, but everyone, from the individual saving for retirement to the multinational firm planning its next big expansion. Understanding this balancing act gives you insight into the broader economy and how interconnected each piece is. So next time you hear about interest rates changing, remember, it's not just a number. It's a signal that can reshape the economic landscape. If this insight resonated with you, consider subscribing for more clarity on market mechanics.